This week at the zoo, the Nasdaq index rallied for a nearly 2.5% gain as the market weighed deteriorating economic data against hope for a new stimulus deal. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we review the previous week's market news and look ahead to the coming week. I'm Christopher Smith.
And I'm Robert Coburn. In economic data this week, we saw a pretty significant decline in the Citigroup Economic Surprise Index. The index measures how much economic data is beating analyst expectations as opposed to missing analyst expectations. For the duration of the pandemic so far, the index has been at an extremely elevated level as the economy came roaring back faster than anyone expected. It's still elevated, but it has ticked down toward a more normal level as economic data soured a little in August. Overall, the economic data show that economic recovery continued in August, but it definitely slowed down. For instance, the National Activity Index this week showed that business activity growth August was about a third as fast as in July. Both initial jobless claims and continuing jobless claims missed analysts' expectations on Thursday, showing only slight overall improvement from the previous week. Durable goods orders missed expectations with a large decline in August in orders for cars and car parts. Consumer credit declined 6.6% in the second quarter, which means consumers have less money to spend. One exception to the slowdown is housing. Housing continues to be a red-hot sector, with new home sales up 4.8% in August, month over month.
The market has been reacting badly to the slowdown in economic data. On Monday of this week, the QQQ NASDAQ fund saw its largest outflows since the dot-com bust in 2001. However, on Friday, there was some important news that could change all that. The House Democrats unveiled a new $2.4 trillion stimulus proposal. We thought that stimulus negotiations were dead, but the new proposal from the Democrats could, in theory, restart stalled talks. The question is just how desperate are the Republicans getting as the election approaches and as Trump continues to trail in the polls by a 7 point spread? Although, frankly, it might be too late at this point for the Republicans to salvage their election chances with a new stimulus bill, since any new bill would take some time for its effects to be felt. So I'm really pretty skeptical that anything will come of this new proposal from the Democrats, but I am keeping an eye peeled next week for any related news.
Speaking of elections, Chris, let's talk about the risk of elections coming up. As we've mentioned on the podcast before, the stock market tends to sell off in February, September, and October of presidential election years when the incumbent loses. We've now had a sell off in February and a sell off in September, so the historical pattern would be for the sell off to continue next month and then for Trump to lose in November. Here's another historical pattern. The stock market tends to do much worse in the first 2 years of a presidential term than it does in the last 2 years. That's because presidents sort of cheat and borrow a lot of money in the last couple of years of their term because they know they can win votes if they goose the economy a little bit. And then in the first 2 years of the terms, they have to raise taxes to pay back some of what the last president borrowed. We have definitely seen a lot of borrowing in the last couple of years of Trump, so regardless of who wins, the next president is going to have a debt problem as well as a recession on his hands. Biden has been talking about raising the corporate tax rate, which would probably hit the stock market pretty hard, but Trump has also said he'd make debt a priority next term. And regardless of who's president, a lot of cities and states are going to have to raise taxes as well. So I think we're probably looking at a lot of political risk right now. Let's talk stocks we watched this week. What were you watching, Chris?
Well, I was watching gold. Gold looked to me like it was gearing up to rip higher, but it actually did the opposite this week with a 5% drop. And that's because gold moves opposite the dollar, and the dollar surged upward this week. The dollar surge comes after months of weakness for the currency, and it may have been driven by Norway's sovereign wealth fund shifting over $1 trillion worth of assets into the United States starting on Monday. Looking at the technicals right now, I think it's possible that gold will drop as low as $1,700 per ounce before it moves upward again. In the longer term, I do still think the environment is good for gold, with housing prices soaring and durable goods orders rising faster in August than at any time in the last 18 months. I think there's clearly some inflation going on, and gold is sort of the classic hedge against inflation, along with inflation protected bonds. So I think that we probably will see some continued strength in gold prices once this surge in the dollar is over. What were you watching, Robert?
So this last week, I was watching Tencent, and I was expecting it to drop quite a bit due to the increasing U.S.-China trade war tensions. But the LA Times reported that a last-minute preliminary injunction in a California district court prevented the ban of the WeChat app. In addition to WeChat avoiding being removed from the app stores, TikTok avoided the ban hammer at the twilight hour, and CNBC reported that Oracle will become the cloud provider for TikTok and handling of the U.S. user data. By housing and handling the U.S. user data in the United States, this appears to have appeased the Trump administration for the time being. I just checked, and both apps are still available in the App Store as of this recording. What does this mean for the stock price going forward? I think the stock price will continue to creep back up if Tencent can go back to flying under the radar. However, the gaming arm of Tencent is still in question, so the stock could take another hit if any further action is taken. Let's talk stocks we are watching this coming week. What will you be watching, Chris?
So this should be a really interesting week because traditionally the last week of September is an extremely bad week for stocks. More than 60% of the time, the stock market goes down pretty sharply in the last week of September. However, with the Democrats having proposed a new stimulus bill on Friday, there is a possibility that we could see some surprise progress toward new stimulus next week. If that happens, then a traditionally bearish week could turn into a big bullish week as investors bet on a new round of stimulus fueled economic growth. So I am watching everything because I think any surprise breakthrough toward a new stimulus bill could send gold, the Nasdaq, the S&P 500, everything all on another very large run. Whereas a failure to make progress toward a deal could kick off the next leg down for just about everything in the market. So I think this would be a good opportunity for what's called an option spread play, where you basically split the difference in options between a big move up and a big move down. I think that we could see a pretty volatile week, and so this probably will be a pretty good week for option plays, really in either direction. What are you watching this week, Robert?
So this week I will be watching Carnival, which have some analysts expecting the stock to surge as much as 120%. I'm not really expecting it to surge that much, as most cruise liners have been sidelined due to the pandemic. And according to cruisehive.com, Carnival has suspended their cruises through October 2020, which is next month. So I can only expect an extremely abysmal quarterly earnings report. I will also be watching AutoZone, which has been recovering well since March. However, after meeting earnings estimates and analysts seeing a strong future, the stock was actually down this last week. So even with the high cost of this stock, I still think this is one to watch and look into buying. Usually, when people have less income, they tend to fix their current car rather than buy a new one. And YouTube makes it easier now more than ever for people to DIY fix their car.
Yeah, I think maybe the poor data this week for cars and car parts may have hit the AutoZone stock, but ultimately that dip in cars and car parts is signaling a decline in the making of new cars, not in the fixing of old ones. So I think probably, once the market sorts out what exactly is happening, I think AutoZone will probably go up while the car makers go down. So I do think that's probably an opportunity there. All right, folks, if you heard anything on the podcast this week that was useful to you, please give us a like, share, or comment on YouTube. You can also find us on social media. We're on Twitter. I post news updates on Twitter throughout the week. We're also on Facebook. You can get our weekly episodes right to your social media feed. We'd also appreciate if you would consider supporting the podcast financially by going to our YouTube video, and underneath the video, we've got a referral link to Webull, which is our trading platform of choice. Webull has great analytics tools and great community, and that makes it a really powerful trading platform relative to some of its competitors. We highly recommend it. And if you deposit $100 into a new Webull account using our referral link, then we get a couple free stocks, and you also will get a couple free stocks, and it helps support the podcast. Thanks so much for listening, and we will see you back at the zoo next week.
See ya.